Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Dayan has spent more than 2 decades in markets, developing a top-down process that seeks to find opportunity in derivatives markets. In his search for value in option trades, he marries a study of the macro landscape with expertise in understanding how to implement and risk manage a derivatives portfolio. With experience across the major asset classes, but a long history in rate derivatives markets, Danny shares his perspective on the fascinating world of pricing in the U.S. government bond market and the giant options complex built around it. We start by reviewing the launch of the hedge fund he founded, DWD Partners, in late 2020, a time of epically low rates and skinny option prices. We walk through key developments, including the expiration of the Fed SLR in 2021 that ultimately played a role in the downfall of SVB and an explosion of the MOVE index, which reached nearly 200 in March of 2023. We spend the bulk of the discussion on how Danny sizes up present-day prices and risks. Here he sees the market priced for substantially more cuts than will materialize. In this context, he outlines options trades to do in short-dated rates that both generate and require option premium. We talk as well about the back end of the yield curve and the explosion of government debt. Here he argues that the term premium for taking duration risk is insufficient. Lastly, he advocates for FX option trades, highlighting the potential that both the euro and Canadian dollar decline as their respective central banks ease policy at a faster rate than currently anticipated relative to the Fed. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Danny Dayan. My guest today on the Alpha Exchange is Danny Dayan. He is the founder and CIO of DWD Partners. Danny, it's great to reconnect and have you on the podcast.
Thanks for having me, Dean. I'm excited to be here today and talk to you about markets. Exciting time given what's been going on in recent weeks.
So much uncertainty there, not necessarily making its way into metrics that we all study like the VIX, but hard to argue that 2024 is not going to be a pretty darn interesting year on the macro front. So, as you said, we'll have a lot to talk about. You've got a couple of areas of expertise, certainly on the macro front, and also you grew up in the rate derivatives market. So why don't we just get the conversation underway? Just tell us a little bit about your background, or maybe more about your framework, how you think about markets, how you think about risk and opportunity, and some of the, whether it's people or events that helped shape that framework.
Sure. So my process is very much a top-down, research-heavy process. At a very high level, what I'm trying to do is identify mispriced macro markets and then design asymmetric derivatives trades that give me larger upside than downside, primarily in option markets. It could be simple listed options, could be more complex over-the-counter exotic options across the main macro markets, rates, FX, equities, and a little bit of commodities and credit here and there. Like you said, we're all a product of our experiences. I have quite a diverse background in terms of how I got to the point of marrying macro research with derivatives trading. It's been an interesting road to get there. Originally from Canada, went to undergrad in Concordia University. My thought process originally was I was going into law, but I took business as my program of choice in order to learn business side of things, as my father was an entrepreneur. And as I studied and took finance classes and in particular derivatives classes, I really fell in love with the complexity of the markets. I fell in love with the complex math behind these products, but also the fact that it's an imprecise or imperfect science. There's no one solution to what's going on in the economy and markets. And so it's always a puzzle that we have to figure out. And I ultimately decided finance was the way for me. My first job on the street was a risk management consultant or advisor for large institutional clients, in particular, the hedging of exotic option trades, strategies, and portfolios at a time when investors were trading far more funky stuff than they do today. This gave me great product knowledge, really gave me exposure to the products themselves, how to derive and back into Greeks, and also risk management framework that is carried forward throughout my career. From there, really felt like, although I enjoyed the role and the focus on the products and hedging of them, I really enjoyed what my clients were doing more when I would sit with them at their desks. And so I decided to go to University of Chicago, did my MBA there, also did my CFA at the same time, and focused on quantitative finance and economics. I landed there just as 2008 was starting to blow up. September 2008, Lehman had just gone under in our first week or two of school. And so I was lucky to be there and learn from Nobel Prize winning economists, central bank experts, all on the very complex dynamics that were happening in the economy and the solutions that were coming forward every single day by policymakers to try to fix this and stem the tide on it. So that was very influential in terms of getting the macro backdrop and understanding of the economy, and then being able to marry that with the derivatives aspects that I'd already gained at my prior role. From there, I went to the sell side, spent 4 years on the sell side, first at Credit Suisse, and then a firm you know quite well, Macro Risk Advisors. The focus was in advising clients on the dynamics, in particular in the rates market, a little bit of FX as well, but also in advising them on trade ideas that I thought were really interesting. I made a little bit of a name for myself as the salesperson who came up with his own macro views and his own derivatives trade ideas. And some of these were very value added for clients in a time when people were confused by quantitative easing and the dynamics coming out of the global financial crisis. After 4 years on the sell side and really enjoying that experience, I was fortunate to be hired by a former client of mine who was launching a hedge fund, a global macro hedge fund, where I joined at launch and was able to spread my wings, I would say, in terms of look at any asset class, look at any sort of trade idea that I had in mind. It was a very fluid process working with the founder in terms of sitting and syncing our macro views together, basically summarizing what we were seeing in the conversations we were having and the research we were doing to align our views, and then work on designing trades to exploit them, executing them, managing the risk, and also working with the junior research staff that we had as well to continue on that process. And then last but not least, founded DWD Partners, which is a fund that launched in October of 2020. And I managed through the middle of last year, I should say. And that was just the ability to put my own name on the door and run the strategy as I saw fit entirely. And it was a great experience.
Well, there's so many directions in which we can take this. And so maybe just start with how you just ended it, which is the launch of DWD coming at a time of historically low rates and an incredible promise from the Fed to keep them low, right? We're in the aftermath of the depths of the COVID market crisis, but certainly still a COVID crisis. We're on high alert. There's this view that the economy is going to need so much help, both monetarily and fiscally. And so you launch amidst these 100-year lows in rates, got to be one of the lowest rate vol environments just because of the import of the Fed's promise at that time. Tell us a little bit about that, just in terms of the market prices that were on offer when you launched the firm.
Ironically, we launched 5 days before the 2020 election. So not just the macro backdrop, but the political backdrop was quite complex as well. And people were quite nervous about that at the time. You nailed it. Listen, it was a very different macro backdrop with the stimulus that was unleashed for 2020 than for, let's say, 2008, even though they used similar tools. In 2008, QE was launched to ease credit conditions in the economy. Now, a lot of market participants at the time expected QE to lead to runaway inflation. And I remember on the sell side, I had a lot of clients who had that view. But my own view, having just come out of Chicago and studied central bank plumbing and things of that nature, was that every dollar that was created by the Fed, the money that was created and printed, was actually just going to stay in the reserve banking system. And effectively, it could be traded back and forth between the various banks. Like Bank of America may have more reserves than they need. They could ultimately lend that out to Citigroup, and Citi could lend it to Goldman, and so on and so forth. And so this actually was something that would not leave the actual financial system and hit the real economy. And so it physically could not create inflation, no matter how much QE they did. What it did do is really change term premiums, risk premiums, and incentivize risk taking, which led to one of the most consistent bull markets we've had in risk assets that entire decade, despite meager growth the entire cycle. Now, come to the 2020 response was massive, both fiscally and via the central bank, via monetary policy. And effectively, they monetized a huge debt issuance by the fiscal government that was meant to replace the hole from shutting down the economy. And that's where it started. Although, of course, once President Biden won the presidency, he did an additional fiscal package of 1.7 trillion at a time when we were slowly opening up the economy. People were starting to get back to work. And obviously, there were dynamics of friction in that process, but overall, the economy was starting to heal from this shock. Now, COVID was still a major risk, and the risk of further lockdowns or people missing work was still out there, but the stimulus was starting to work its way through the system. And that last fiscal package was frankly unnecessary and was essentially throwing gasoline on a fire. So what it led to was a very overheated economy in 2021. My anecdote, again, you talk about interest rates, was really interesting observing this period, because I don't think we can talk about today or 2023 without talking about 2021. And I think some aspects of it are actually misunderstood. And the dynamic of 2021, we had exceptionally strong growth by the middle of the year. The economy had fully reopened. We had about 13% nominal GDP. Most economists would say potential is 4.5. We had very strong growth. And then on top of it, inflation had started to pick up over 5%. And yet, August of 2021, 10-year yields were 1.2%. And so the Fed was buying not only 120 billion, which is what everyone knows publicly, but they also were reinvesting any maturing bonds from their balance sheet. That was another 40 to 80 billion a month. And then there was a regulatory change called the SLR exemption that expired at the end of March 21, which meant that banks, being regulatory constrained and being flooded with deposits, effectively had no choice but to buy a ton of bonds as well. And so by my estimate, it came out to something like 300 billion of bond buying that is price insensitive, that is buying bonds at 1.2% in August when the economy was overheating. Now, the reason I'm going to point to this is not to pinpoint on the Fed's mistake, which many people have done. The reason I think that this is important is this exceptionally large bond buying distorted the bond market, and it distorted the yield curve, made it flatter earlier in a cycle than you typically would get. So typically when the economy comes out of a recession, it starts to accelerate. There's a period of time where central banks allow that to play out before they respond with tightening policy. And you'll typically get a steep yield curve in this period of time because the market anticipates future rate hikes. Between the massive QE and the Fed's messaging that rates would remain low for years to come, we didn't get that steeper curve. And if we had, that steeper curve would have done some of the work for the Fed before they tightened. And so this was something that's been missing from this cycle. And it's possibly why they had to go higher than many people thought they would have to go in terms of policy rates. And the second thing is, it's related, is the term premium. Typically, a term premium is an unobservable metric, but at a high level, what this tells you in the bond market is this is the compensation that you as an investor get for extending your duration risk. So instead of buying 1 month T-bill, which has really no risk to it, there's no real duration risk to it. If you buy a 10-year bond or a 30-year bond, you have that risk of reinvesting short-dated proceeds into it, but also future uncertainty around policy, fiscal spending, and all of those things. And we had a deeply negative term premium. And this was as a result of all that QE, as I mentioned. And so, again, it just led to an overly flat curve ahead of the tightening cycle, which has led to, in my opinion, a lot of investors and economists getting wrong-footed by the inverted yield curve and declaring it would lead to a recession around this time, which hasn't materialized, obviously.
Let's run with this word distortions, because I think that's an interesting area for us to explore and maybe give you a jumping off point to share some of your views on the here and now of pricing. And certainly when you sprinkle in the word price agnostic, our anticipation of the word distortion should be coming, right? So we should expect distortions if there's price agnostic behavior. And the Fed and its central bank cousins around the world are probably one of the more price agnostic actors out there. Maybe you put the index fund in there, right? It's just, this is what I have to do. I'm kind of solving for a problem that maybe asset liability managers are in there. But at scale, it's hard to say that the Fed isn't one of the largest price agnostic actors in the market. And so when you step back and you look at today, so let's sort of fast forward through 2021, 2022, 2023. And what do we see today? We've got a reemergence of yield curve inversions, especially around the kind of spot to 2-year point, right? There's on that WIRP page, it's something close to 7 cuts now out to even Jan of 2025. That seems like a lot. Walk us through the mosaic of prices that you look at now. Which seem to you most interesting? Are there distortions that you identify? And if so, what do you think's driving them?
Absolutely. If okay with you, I'd like to jump back to 2023, which will set the stage for 2024 and what we're at now. So coming into 2023, there were a range of outcomes people were expecting. One was an imminent recession. The other was kind of just grinding, slow growth, like soft landing-ish sort of dynamic. My view, having studied these high inflationary periods, was we were likely to get a reacceleration in the economy. And the reason for that is twofold. One is when you have high inflationary periods, inflation can come down in one of two ways. If it comes down really rapidly, you're looking at a collapse in economic activity and a deep recession. And so that will solve itself effectively. But alternatively, if it comes down gradually, which is what we had and have had, without material economic damage, meaning without any hit to employment, well, then what ends up happening is the decline in inflation works as a tax cut. And so my view was that as inflation continued to move lower in a gradual manner, that you actually get a boost to real wages. So to set the stage, households and employees, workers in the economy have been earning around 5% wage growth on a nominal basis in the last year and change. But their real wages towards the end of 2022 were negative 4%. Now, just from inflation moderating, that turned into a plus 1.5% over the course of the middle of 2023. And so effectively, with nothing else changing, that means that as a consumer, your purchasing power is improved. And so you still have that strong nominal wage growth. You still have very healthy balance sheets. You still have your job. And you still potentially have wealth in the housing market and equity markets that are supporting you, potentially even some excess savings. But now you have extra money in your pocket. And then you can even throw extra fuel to the fire by oil coming from $125, $130 down to $70. Again, oil and gas expenses are something we can't avoid in our life. But if they come down 30%, that means I have a little bit extra money in my pocket at the end of the month. And so with a very high velocity economy, my expectation was we would reaccelerate. At the same time, adding fuel to this, at the end of 22, we had a substantial easing in financial conditions, actually very similar to what we just went through at the end of 23. So we'll get there in a second. So coming into the beginning of 23, I expected the economy to reaccelerate, and it started to. Obviously, then SVB hit. I didn't anticipate this. I don't know too many that did, but it put a wrinkle on things. Number one, in terms of the fear of bank failures a la 2008, but also the very volatile interest rate markets over this period. And so what started with the SVB scenario was It wasn't a credit crisis. Okay. It was very easy to determine that right away, that this was not the same as 2008, where banks were afraid to have trades on versus other banks and to manage that credit exposure. And clients were afraid to face banks in some cases. And that was a credit crisis. In 2023, it was a liquidity crisis. The low cost deposits were now fleeing at a rapid pace. And so the Fed responded very appropriately and quickly with their BTFP facility, which replaced liquidity for any bank that needed it. Now, it came at a cost. Before, deposits were zero, or very close to zero. Banks were really not raising their deposit rates as rates had risen in the economy. But now, to use the BTFP facility, their financing costs would be risen or be an impediment for them. And so it became a solvency issue. And it became a solvency issue for just a few banks. It really wasn't systemic like the big fear was. Now, what's interesting is how the markets responded when SVB did fall on that Friday, because that Friday we had just gotten the second exceptionally strong jobs report, which you would think would lead to expectations of higher rates. But the 2-year yield fell something like 45 basis points in the matter of the day. And then we started to get reactions in the vol market that were astronomical. A 3-month, 2-year vol went from 140 normal vols to 240 in the course of a very short period of time. 2-year yields went from 5 to 375, and even the out of the money skews for receivers for even lower rates than that were 260 to 280 normal vols. And so these were just panic volatility levels. And one of the things that caused this is we had a perfect cascade of events here. So we had short covering of a lot of short positions. Most people in the markets were short the front end of the curve. You had the systematic community, the CTAs had to cover as this played out. But you also had some bad vol exposures. And as you know from working in the option markets for many, many years, there's typically with these volatility events, someone out there or a series of investors out there that have offsides vol exposure, and then to scramble to get that risk back leads to even more erratic pricing and volatility dynamics, which can be very destructive to investors. And so what we had is, prior to SVB falling, we had a reaccelerating economy. And so a lot of traders out there said, there's no chance of rate cuts anytime soon. I'm going to put on 1-year, 1-by-2 receiver spreads or receiver ladders where you buy one strike, sell two lower strikes. And the hope is, as we progress through the year, this carries positively, those low strikes decay on you. And then if they do cut rates a year from now, I'm in a position where I'm ready for it. Great in theory, except that when you have a 45 basis point decline in one day and vol exploding, if you're short that volatility, it's extremely painful.
Danny, let me just jump in, just because there's some jargon there, even for the expert listener base of this podcast. But the old 1-by-2 put spread, you're effectively buying a put spread and then selling an even lower leg, oftentimes to fully finance or something close to it, the put spread, with, of course, the risk, as you're outlining, that the overshoot, you go too far. And boy, that rates rally in the kind of 2-year segment post SVB was just extraordinary. And I like the framing of it as perfect storm, because you had an event of significant consequence. Obviously, it invoked a Fed emergency response, and you have some trades that seem leaning the wrong way. And then, as our friend Harley Bassman likes to say, when looking at an episode of financial vol event, convexity is often lurking at the scene of the crime.
Always.
So, yeah, go ahead.
So what happens in these scenarios is people are getting tapped on the shoulder from risk managers and their superiors and their bosses and saying, you got to get out of these trades no matter what. You can't say a year from now, this trade will look great, or 6 months from now, this trade will look great. What you have to do is get out of the trade at all costs. And so you end up with a scramble to buy that lower strike volatility, which led to those vols going up even higher. And so it ends up this cascading effect. Now, I personally don't love to put on 1-by-2s or receiver ladders or put ladders or whatever asset class it is when markets are calm. I'm someone that actually would only come in and do those trades when in the eye of the storm, like we just talked about. So if you come in at that point in time, once you determine that the Fed has solved the liquidity issue and that this is a solvency issue, and solvency issues are very slow moving and they take time to play out. Firms don't just go bankrupt because their funding costs went up. They don't just go bankrupt relatively quickly from a healthy position to a bankruptcy position. It takes time for them to eventually determine that lending is no longer economically viable for them, and maybe they need to cut costs or cut their lending book and so on and so forth. So it's a slow moving story, even in a worst case scenario on that front. And so I like to come in at these points in time. And so now you had the forward rates all the way down, expressing 130, 150 bips of rate cuts for the rest of 2023. I determined that it was not as bad as feared. Obviously, what was allowing me to put on trades like this or to express trades like this is to recognize that whoever got hurt in this episode can't just turn around and put the same trade on. They're going to be risk constrained as a result of having been badly burnt by this episode. And so forward rates stayed pretty inverted with the rate cuts, and vols were very expensive. And why I call them eye of the storm is at this time, if you put those trades on, you'll get exceptional value from them because the dealers would love to buy that volatility from you. It's extremely expensive, but it's delivering every day. So they'd love to buy that vol from you, especially because they just sold it to clients when they unwound their trades. So there's exceptional opportunities for ideas like that. I was talking and advising people, whoever had the bullets to do those trades, to do them. They were like roughly 15x within 3 to 4 months. But the more important thing to talk about here is, as this got resolved by the Fed, and as this situation, the acute nature of this situation calmed down, what ended up happening is we had deep rate cuts priced into the curve. Because of the Fed response, equities rallied, which they do when there's usually intervention and stimulus. And we had a situation where this eased conditions aggressively. And so that led to Q3, the economy re-accelerating sharply, and we got a roughly 5% real GDP quarter. And with inflation of 3% you're looking at 8% nominal GDP, which is a very, very strong quarter. And we also got what I had been waiting for a solid 6 months, the term premium tantrum, or that's the name I give it, where the back end of the curve started to operate independently from expectations of monetary policy to reflect extraordinarily large fiscal deficits. We had 7% of GDP deficit in an expansion year last year, which is very, very unusual. And we had huge funding announcements at the end of July for the refunding of the treasury market. And then it didn't take much for investors to see the writing on the wall is that we have these exceptionally large deficits for years to come. And some of the buyers of treasuries, the biggest buyers, are stepping away. China's not buying due to geopolitical reasons. The Fed is obviously not buying anymore. Japan has backed away. I mean, I don't think that's permanent, but they did back away for a very long time from the bond market now. Banks certainly were not in a position to add to their securities portfolios given what happened with the SVB blow up. And so you had the situation where you need a clearing price, a higher clearing price or higher yield in order to source all this paper and return some term premium to the curve. And so that ultimately tightened conditions substantially over the course of Q3's reacceleration. And that's led to Q4, which is an exceptionally volatile period for the markets, but in my opinion, is being misread by a lot of different investors.
There's a couple things there. So the first part I wanted to go to, and maybe we can cut the area of, or divide the discussion, the exploration in half by the yield curve. And so we've got these two reasonably epic curve moves. First is SVB. So let's call that the epic bull steepening episode. And then, as you were just talking about late July, you've got this pretty epic bear steepening episode. So I just wanted to go back to SVB for a second, because as I look at the WIRP page and the implied cuts, it's a tall order for the Fed to deliver. So out to Jan 25, you're basically at 7. So if those are, call it 150, 175 basis points of cuts, if we're just going to stay with 25s. You'd made the point that post SVB, we got to on the order of 150, and I'm seeing the same thing. So as late as May of 2023, the Jan 24 cuts implied were about 4.5. Okay. Of course, completely unfulfilled. And the market wound up doing pretty darn well over the back half of 2023. And so my question is just around the curve now, these almost 7 cuts that are priced in over the course of a year. How would you characterize that in terms of the why of that, the probability that materializes, and then the implications of it either not materializing? I think Bostic was on the tape today saying some stuff that was a little bit more like, look, let's not expect rates to start coming down so quickly. So maybe a little bit of pushback on some of what's priced in. Walk us through what's on your mind in terms of the pretty deep inversion we see between policy rates and, let's say, 1 and 2 year treasuries.
Sure. I mean, look, the SVB bull steepening to me made sense because there was real fear. This wasn't just a positioning story. It wasn't just a refunding story. And you had a good old fashioned bull steepener. Now, obviously, it didn't play out that way. The economy chugged along, and so it unwound. But you had a good old fashioned bull steepener. And in fact, over that period when 2-year yields were plunging, the 30-year yields didn't move down that much. And so that made sense to me is that, look, if there's an idiosyncratic reason we have to ease at a period of very strong growth and inflation, that it should reflect in the future, we're going to have to unwind these cuts. So that made sense. The bear steepening in Q3 was really because the economy was reaccelerating and the Fed was more inclined to sit on their hands. And so as a result, you're not going to price more rate hikes because the Fed is indicating they were more likely not to hike rates. And you're going to price the back end of the curve, which was not only strong growth, but massive supply and the premium required for that. These made perfect sense. The current curve dynamic to me doesn't really make a lot of sense. And it's a little bit of a misunderstanding why Q4 was a little bit weaker to start with than Q3. And the big reason for me is having studied financial conditions in this economy, it doesn't always play out this way, but in this economy where we have full employment, strong household balance sheets, wealth is exceptionally high, what drives the economy is the marginal change. Nothing else in the economy has changed from one month to the next, but big financial moves have changed that will impact the economy. So in Q3, when we had 10-year yields go from 3.50 to 5%, that put mortgage rates all the way up a little over 8%. And so it's natural that that will temper some demand, and that tightening will lead to a weaker growth impulse from there. Now, it seems the Fed and many in the markets have missed this because subsequently we have unwound all that tightening and we have eased substantially to, however you look at these financial conditions indices, almost back to when we first started rate hikes. So it's shocking to me that when I talk to people or when I look at the market price action or even central bank speeches, that they don't see the risk of a reacceleration on the table because we did just come out of Q3 with a 5% GDP quarter. And then you take rate cuts substantially lower. But not only did you get the front end sharply lower, you got the back end lower too. So you didn't get the real bull steepener that we got in the SVB story. You got essentially first a bull flattener, and then you got some bull steepening. But really, it started out as a bull flattener. And so the 10-year yield went from 5% to 370, and mortgage rates subsequently went down 130, 150 basis points. And so we've already seen early days. In my opinion, these lags are roughly 2 to 3 months before they impact the economy. But we've seen a little bit of increased activity in the housing market. Purchase applications, have been up something like 8 of 10 weeks. The weekly economic index, which is about short-term indicators like jobless claims, red book sales, again, the mortgage applications I mentioned, that's inflected higher sharply. And so it just seems to me that the markets are pricing absolute certainty of two things. One, inflation is solved or very close to solved. And two, the neutral rate of the economy has not changed from what it was last cycle, which most people put at 2.5%. And my view is it really was the sharp tightening in financial conditions that led to some weakening in Q4. It's not like the lagged effect from rate hikes being at high levels led to Q4 just magically weakening. And I think the markets are extrapolating this a little too far. So now the challenge, as I see for 2024, is the Fed had opportunities to push back against the easing in conditions. They didn't. And then they made what I think is a communication snafu at the December FOMC by opening the door to rate cuts. And that's led to even further easing in conditions and sustained easing in conditions. And so I think when they were at the October 31st levels, where every part of the yield curve was above 5%, we had very little rate cuts expectations for 2024. This gave the Fed the ultimate optionality in that, let's just say the economy continues to chug along. Well, this gives you time to figure out a couple things. One, has the neutral rate changed? Two, if the economy is resilient to higher rates for as long as it has been, you would think like maybe there's some chance that the neutral rate has risen. Two is the structural inflation. You could start to see how much of this inflation can we really deal with and how much of it is structural, sticky, that would require a lot of damage to the economy to deal with. And maybe they would say, we'll tolerate it for now because it's due to things like demographics that we can't control. That gave them that optionality. And alternatively, if the economy did weaken aggressively, like very sharply, I should say, they could respond with 200, 300 rate cuts, 200 bips of rate cuts quickly. And I would also say that from a communication standpoint, it's important for the Fed to communicate ahead of time when they're tightening policy, because you don't want an accident. You don't want financial conditions to tighten too abruptly and lead to market accidents or things that could lead to a complication for conducting policy. So you want to kind of telegraph rate hikes, especially when you're certain about them. Rate cuts, you don't need to do that. You can come in on a weekend and cut 50 bips on a Sunday night. You can come in at a meeting with it not priced in at all. And whenever you cut rates, it'll be cheered by the markets and it'll be cheered by the economy with a lag. And so I think by telegraphing it, they open the door to something that they won't be able to rein in if the economy reaccelerates. I give the example of, let's say they just don't cut in March. It's like 75 or 80% price. They don't cut in March. Well, when you open the door to rate cuts, the market knows that's the next direction. And it's just a matter of when and how fast. So I don't think that'll tighten conditions if the economy reaccelerates by just skipping a meeting or two. What I think will happen is the market will just simply push those cuts to future dates. And that is what leads to 5-year yields, 10-year yields substantially lower than where you need them to be to tighten conditions sustainably. And so I think in that scenario where the economy reaccelerates, I think they're going to have potentially credibility issues in pushing back on it. We've seen in the last 3 weeks, they've tried via speeches to push back, and pricing really hasn't budged much.
Let me just jump in on how you think about setting something up on this. So, as we said, there is quite an expectation of rate cuts. It's not 2 or 3. You're at 7 over the course of next year. Now, we can argue that that's how the math works out. Maybe there's just a lot of skew there, right? So the base case is 3, but there's some disaster insurance. I don't know. It certainly feels like a lot. And as we showed in 2023, leaving those unfulfilled doesn't necessarily spell disaster for the risk asset complex. It can happen that we just continue to have no landing and the economy just turns out to be not very sensitive to interest rates. But let's just go with your base case. It's a very high bar to get to this level of cuts. What's the trade, as on the run a trade to do that has kind of a risk management overlay, right? So I want to get exposure to this notion that we're just not going to get those cuts. Maybe I'm willing to do it in option form because I don't want to risk something on an unbounded basis. How do you think about the expression of that view?
That's a great question. And the opportunities right now are exceptional in this front. If you share the same view that I have, what you could do is a few things. One is the premium for further rate cuts, even beyond what's priced, is actually still there in the option markets, meaning the skew is rich for calls in SOFR space or receivers in OTC space relative to at the money vols. So if you have that sort of tolerance of I'm going to put something on and leave it, you can sell deep out of the money call spreads in like June or December of 2024 that if they don't cut anywhere near as priced and beyond, because you'll sell further out of the money, you'll just collect that premium over time. So it's a positive carry way of getting exposure to them not delivering the cuts that are priced. And alternatively, a safer version of that trade would be to just buy put spreads in June or December. And you can actually buy put spreads that still leave cuts on the table, but fewer than what's priced, and get payouts of something like 10x. And on top of it, the forward curve being as inverted as it is, assuming nothing changes and those cuts are not delivered, you roll positively. So these are positive carry trades that are long volatility. The forward curve roll up to spot will pay for the volatility that you buy. So you can look at that as almost free options in the scenario where nothing happens. So these are great trades. In my opinion, I like the put spreads because I think rate vol has come down quite a bit on the expectation of easing. We're pricing 5 to 7 bips a day break evens in rate vol. And you look at a day like today, Waller had his speech. We moved similar amounts on PPI release on Friday and moved similar amounts on CPI release last week. We routinely have this gap risk in rate markets that I think rate vol is a good value here. If you share my view that rates have upside, not downside. If they have further downside, when you get to a lower yield level, it's inevitable that vol will actually decline because the distribution sort of narrows when you get closer to zero, although we're not pricing a return to zero, but a pricing of 2 to 3 range would lead to a lower volatility level. So that's why the short call spreads, if we just grind lower on rate cuts, don't deliver as much. Those will be short vol, but I like the put spreads personally. I also think it's a great, as I mentioned, since vol is cheaper, to position for higher back end of the curve, because the Fed has kind of shown their cards. And even if they won't deliver those cuts, inflation is still elevated, but they're turning their eyes towards growth a little more and kind of balanced between inflation and growth outcomes. And as a market participant, in particular the equities, are looking at this as the Fed has your back. So you can buy the dip again, because if the economy weakens, the Fed is going to cut aggressively. We're at 5+ rates. They can easily take it down 200, 300 bips. Drastic moves that you could not see when we were at 2%, right? All last cycle. And so from an equity investor perspective, it's almost like an asymmetric bet that they're going to have your back if anything weakens. And so in that context, I think future inflation should start to be priced higher. What I find the most unusual beyond just the rate cut pricing, Dean, is anywhere from 1 year, 2 year, all the way to 5-year CPI swaps. These are zero coupon inflation swaps. They're all pricing roughly 2 to 2.2%. So there's almost no premium at all. After 3 years of elevated inflation, the market is 100% certain this is finished, and that easing the way that's priced into the market won't lead to a second wave. I think that's an asymmetric bet to trade otherwise.
And just also thinking about asymmetry, I wanted you to just comment a little bit, and then I wanted to leave like the last 5 minutes just a bit open-ended, just to get some of your thoughts on what you see in the world of market prices. But let's just talk about the back end. And we referenced earlier that bear steepening episode. I mean, look, to me, there's nothing more interesting and potentially frightening than a risk event that has as its centerpiece the US Treasury market. Just not a good thing. And it's hard to argue that the mature folks are kind of running the show here. I mean, there's just no appetite in the US political conversation about debt reduction or about the risks here. And the risks seem maybe not tomorrow, but from a longer term perspective, they're pretty profound. We're up against quite a debt stack here with no plan. It doesn't seem, no appetite for a plan to get this stuff under control. And I just was wondering if you could share some thoughts on, you used that term earlier, market clearing price. You got to find a clearing price. It's got to trade somewhere. The best customers have left the building. Talk to us about what you see on the long end. Where do you see that going?
Right. So after 2008, we had a Fed that manipulated the bond market in order to ease financial conditions, as we talked about, by doing this large QE programs. But prior to 2008, for decades, we had what we call a term premium in the 10-year part of the curve between 100 and 150 basis points. Now, in the extreme 1970s and 80s, it got to something like 300 to 500 basis points, but that's not normal. If we talk about the 100 to 150 basis points, that's the added compensation that you're requesting from the market in order to take on that longer dated paper. So from my perspective, with everything that I see in the world, I see structural inflation from demographic change. I see the fact that we're going to have persistent labor shortages all throughout the economy for about a decade. There's onshoring or reshoring, however we call it, where we're reworking global supply chains, more domestic production from just sourcing everything from China and other emerging markets. We're clearly in a period of geopolitical complications, not just the two wars that are out there and the possibility for even more, but the political dysfunction where these two parties can't seem to function together or agree with each other at all. For my seat, I require a risk premium to buy 10-year bonds, 10-year yields, or 30-year treasuries. And we don't have that. The term premium that we built was very modest in Q3, and it's completely unwound and it's negative or zero again. So I think that you require a compensation to take on this longer dated risk because of these dynamics. You mentioned out of control fiscal deficits. You're spot on. There is no appetite to rein that in. And if anything, we're underpricing these deficits for a couple of reasons. One, I think military spending is likely to go higher than expected because of the geopolitical dynamics around the world. Two, we have a recession at some point, and I could expect whoever's president to do some sort of fiscal package when that happens. I think they've introduced a new policy lever when there's a recession, and it's politically very well taken to do things like fiscal spending to stimulate the economy. And then last but not least, in 10 years, nobody talks about this, but in 10 years, Social Security is in deficit and is going to be underwater. And no politician has any appetite to deal with this now, but we know that it'll hit a breaking point at some point and they'll have to plug that gap. Somehow, I anticipate more spending. And so when you look at this dynamic, it's clear that this is not just a one-year thing. This is going to be with us for multiple years to come. And it's a little scary, frankly, because we're getting to debt levels that are very, very, very high. And like we've both talked about, there's no appetite to rein that in.
Well, let's round out with just some of your broad thoughts in terms of what you're studying when you kind of look at the world of prices, both on an absolute basis, how they carry from an optionality standpoint, how they look relative to one another. So we talked a little bit about yield curve relationships. First question is, what, if anything, is especially incongruous to you outside of what we've already talked about in terms of the implied cuts? And if something is kind of a head scratcher, is there an implementation vehicle that you've trained your eyes on that looks pretty interesting and efficient?
This is a tough question because what I think is the most mispriced thing currently, besides what we talked about already in the US specifically, is the fact that other economies that appear substantially weaker have the same amount of cut pricing as the Fed. And so that's very unusual. I mean, Europe is essentially not grown for a year, and their growth engine has been severely curtailed by the energy shock that they went through. And they're a manufacturing, exporting powerhouse that's contingent on sourcing cheap energy to do so at good costs. And That's how their economy essentially expands. And we've had the euro go from 95 cents to $1.10 back to 104, 105. And it really hasn't had an impulse positively or negatively to the European economy, which is something that surprised me. But when I see this similarity in rate cut pricing between economies like the US, UK, Europe, that is very, very, very odd to me. Now, because of how correlated the bond market is with each other, I find them difficult trades to do cross market rates one versus the other. So it leads you to FX. And so a little uncomfortable of a position to be in, but to be long the dollar, because if we do have the scenario I pointed to, which is a credibility situation, one of the vehicles that you would expect is the dollar would weaken. So at the same time, I can't justify what the euro being close to 109 or 110, given the dynamics that they have. European Central Bank research came out last week that really indicated that 70% or so of the inflation they had was supply chain related. And a lot of that's normalized. So it's a very different dynamic from the US, where you did 20% of GDP fiscal spending and handed that to people, handed that into the economy. And then look at other economies that also have weaker positions. For example, my native Canada has a very vulnerable household sector in terms of a lot of leverage. Interest payments as a function of disposable income are at record highs. The housing market never corrected in 2008 like it did in the US. So it just kept plugging along and is very expensive any which way you measure it. And so a vulnerable household sector to debt obligations is very different than the dynamic we have in the US, where they're almost impervious to the interest rate moves thus far. And even the corporate sector in the US, their net interest payments have declined. So I look at the difference of economies and it makes me want to be long the dollar. But I'm also a little hesitant because I think there might be a credibility situation for the Fed this year. But that differential between economies, I think, is going to play a factor this year. And I think it's too early to say, but I think we may get a currency market where some dollar trades, the dollar trades stronger, some dollar pairs, the dollar trades weaker. Australia is an example where they have not tightened anywhere near as much as the Fed. As a result, they have stickier inflation. And so they're less likely to cut rates than most economies. I would say they're on par with the US, but less likely to cut rates. So if risk assets continue to do well and commodities do well, then the Aussie dollar could appreciate. But then you flip around and you say the euro could depreciate or the Canadian dollar could depreciate. It's been a very long time since we had a currency market with divergences like this, where it wasn't just dollar on, dollar off, dollar on, dollar off. So I'm hoping we see that, because that'll make for very exciting divergence trades that you could put on among economies. I would also add in equities. I would say we're not at a stable point here, sitting at 1% away from the all-time high. In terms of what I expect is explosive moves one way or the other. The market obviously has this reflexivity in the vol market, as you know, where low realized vol leads to more systematic vol sellers, which brings down implied vol and kind of leads to lower realized vol again. And this cascades to the point where the vol market looks very boring right now. That being said, from what I'm seeing, there's slowly some dynamics that are changing where dealers get short gamma on downside moves. That hasn't been in place for a while. Dealers also are short VANA, meaning they have volatility to buy for declines in the spot market. And so we have had a situation for 2 years where declines in the market were gradual and rallies were explosive. And we may get explosive on the downside again, if we get that. Alternatively, I could also see if the Fed is unable to push back on the easing when the economy reaccelerates, according to my expectation, we could get a melt up in the equity market to something people aren't thinking about, like 5,500, 6,000 relatively quickly. Because if we have another Q3 and this time around, they aren't able to push back and we don't get the bear steepening we had in Q3, well, then the economy could overheat. And that's a scenario that nobody's really talking about or playing for. But I think either way, I'm happy to prepare for equity moves 5% or larger in either direction, as opposed to we're just going to chill here for months on end. I could lose premium, but at a 13 VIX, I'm very comfortable with saying that this is a good entry point for vol explosive trades in equities.
Yeah, it's like a flea market for vol buyers out there, and USD CAD is probably the centerpiece of it. It's a 5 implied, 0th percentile, so pretty interesting there. Well, Danny, this has been an excellent conversation. I'm so glad we had it, and thank you for being so specific with the views and also the implementation. I know our listeners are going to enjoy following the conversation, so thanks for taking the time.
Thank you very much, Dean. It was great to chat with you and to be on the Alpha Exchange.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.